decision making. And I have prepared for you an overview of the, let's say, to weight the decision make or buy process. And I'm going to start with the pillars of this decision chart. Okay. Then I will go into the make in-house. And then I will continue and finish with the buy. I hope this helps you order the criteria better and eases the study. So it's just creating a chart, okay? I'm gonna go to the individual points each. So let's start. The first one is the first of the pillars is the business strategy. Business strategy, and I'm going to focus here for a little while. So, business strategy. What do we mean by this? We need to weight when we decide if make or buy, we need to weight the attractiveness of the process or product. Attractiveness of the product or service. Needs to be evaluated from a customer perspective. Okay. We need to weight the criticality for the overall business success. In 2 dimensions. Who is the proprietary of the process and product? Okay. And the second dimension, do we need a product differentiation? So is this product strategically important or not? We need to weight the industry dynamics and the competitive positioning of the company with regards to the product, and we need to take into consideration the dynamics of technology or capability for the organization in 2 dimensions: the rate of change is the product going to be changed very fast, or the rate of core capabilities. The risk of core capabilities. If we give the product to buy, maybe we might lose some core capabilities that we don't want to lose. Okay? As a rule, it is desirable to choose make when the product is critical for the company's success, or is considered a core operation. Conversely, outsourcing is strategically advisable if we seek to eliminate the burden of capital processes, capital intensive processes, if we want to reduce cost. Okay. If we want to gain flexibility to adjust output, Um, or if we want to leverage external expertise. Okay. So here we make a little, let's say, decision tree. Let's say we have a process, or no, like this is better. I like it more. Let's say we have a process here. Or a product. And then we go and say future competitive advantage or emerging technology. Future competitive advantage or emerging technology. And then you can say yes or no. Okay. If it is yes, then the product is strategic. And then you should make. If you say no, then you can say is core critical. Es ist kritisch, wenn wir hier nicht lieferfähig werden. Core critical. And you can say yes. And then the product or the process is core. So you need to make or buy ensuring capability. Can you follow the argument? Please answer. I cannot see if you are answering. Can you follow? Ist es verständlich? Ja oder nein? So, okay, I don't see any answer. If you are answering on the chat, I cannot see it. So please answer with your microphone, okay? So if it's not critical, then you ask, do we have pre-existing commitments with supplier? Okay. Pre-existing commitments with supplier. If it is yes, then we want to do outsourcing. No, wait. Here we want to renegotiate with the supplier. And if it is no, in both cases, we do outsourcing. And we need to manage investment as a buy. Okay. This is basically the idea from a strategic perspective. Questions, please. So this is a little bit the way we think about it, okay? Here we have a process or product. Or service or something that you want to sell. Okay. So, does it make sense? Yes, okay. So from a business strategy perspective, we want to make if the in-house process differentiates the product or service. Okay. I mean, some of these points were already pointed out yesterday. I'm just making a big chart so that you have everything. If the capability used for the new product or service has synergies across the business, if we have similar machines, or if we have similar capacity that is unused, we can use easily if we have the know-how, etc. Third, if the supply market is hostile or controlled by competitors, or if we need to push the technology into the market. Okay, we in-house. We buy otherwise if the process of business is unattractive, for instance, in example, that's what IE means. We have, it's hard to work, hard to find workers, or we have a strict regulatory environments that are not so strict at the supplier side. If the product or service are not critical to end products, or marketing efforts, if supply market is suitable or building close partnerships. And last, if the suppliers are not willing or able to meet innovation needs. Sorry, are willing, not are not willing, are willing. Well, it doesn't make sense, the sentence. Suppliers are willing and able to meet innovation needs. Okay? So this is the first pillar of the overview I'm giving you, the business strategy. Any questions, please? Does it help to have this overview or doesn't? Okay, I don't get any feedback. I don't know. Yeah, okay. So the second pillar are the risks. Risks. And here we need to look at following. We need to look at availability of alternative sources and switching costs. Remember that the supply chain networks are dynamic and are subject to change. Okay. The supply market risks if foreign sourced. Okay, so if China has a problem with the US, then they stop delivering the US, and then a lot of companies in the US would suffer supply chain shortage. Okay, for instance, political stability, or Also important, exchange rate. Volatility. Okay, if the dollar gets too expensive as compared with the euro, then there are supply chain disruptions, for instance, or as mentioned yesterday, transportation risks. Like impacting the lead time or impacting the supply chain. Disruption. Might be also a risk associated with the intellectual property. Protection. Okay. Those are basically the risks associated. Any questions? So in general, it can be said that risks include lower quality at supplier, reliability, and predictability of outsourced product or services as compared with in-house making products. Okay. There are also risks inherent in the process of identifying and selecting the right supplier and structuring a workable, ongoing, trustworthy relationship. Okay. Let me put the thing down here a bit. Dismiss. Speech is read only. weiß nicht, was los ist mit dem. Okay. Okay, ich darf anscheinend darf ich nicht so lange Linien darstellen. Gut, also another comment here. When there are multiple suppliers, a single failure in the chain may not be fatal, but by strategies bring a number of unavoidable risks, and the evaluation should be carefully done. Okay? Good. Questions, please. So when do we taking into consideration these risks? When we have few or no alternative sources of supply. Okay. If we have high market or supply market risk, high supply market risk, if we have an imperative to couple supply and usage, this means if we have a very short lead time, or if we need short lead time, for quick response and quality, or if there is sensitive intellectual property involved. Okay, that's when we make, well, you have it up there. Well, I'll put it again, make. Or when do you buy? So we buy when the hold-up risk is low, or sufficiently managed. Through contract or broader business relationship, or broader business relationship. For instance, when Daimler partnered up with Mitsubishi in the 90s, Schremp wollte Welt AG machen. Daimler hat eine Zeit lange, Daimler did share all the drawings of all the cars with Mitsubishi. When the partnership was gone, Mitsubishi have had access to all the drawings, the technical drawings of Daimler, and all the technology was could be found a few years later in all Mitsubishi cars. Okay, so you have a certain risk when you partner up, when you share, when you go out of your business, and you should be careful. So there is low, if there is low switching costs involved, and there are easily accessible alternative sources of supply, if there is uncoupling the supply chain, if uncoupling the supply chain has little impact, or if there is no, I mean, it's the opposite of the other, if there is no intellectual property, sensitive intellectual property involved. Okay, so that's when you go and you buy. Questions, please? So the third pilar, I hear no questions, so I guess I can continue. The third pilar is the economic factors involved. make or buy. Let's use a new pretty color. So the economic factors that you need to take into consideration is if there is a relative economic and operating performance advantage, economic and performance advantage by making or buying. Okay, so we can say, can we scale the business by outsourcing? Okay, or can we increase utilization of our patents? Here we ask ourselves about the reliability, trust is fundamental of our suppliers. Here the supplier manager has a big responsibility in the company. What are the cost factors? We will talk about that later on. And do we have quality issues related? Okay. Have we calculated the financial capital requirements and financial returns? Capital requirements and financial returns. Break-even point. We will do an exercise in a couple minutes. And we need to assess the level of skills and expertise that we take care of. Necessary. Okay. So those are the economic factors to take into consideration. Then we go and we say, okay, what do we need to, if we want to make? We ask ourselves if we have an internal cost advantage or parity. Schwarze Null, okay, or high quality if we produce at home, or we have a significant recent investment in process technology that cannot be recovered. So the investments meet required return on invest quality, on invested capital, the so-called return on investment index, or ROE, super important. And the company has a strong defensible skills base. Okay. And then we go on buy if the opposite. It's always the same. It's kind of I don't know if this is helping. I just prepared this. I hope helps you get better into the matter. Suppliers have lower costs. Here, be careful. Overall supply chain cost. Okay, we talked about that yesterday. Or better quality. It can be that the supplier is an expert in that specific process, and that makes sense to outsource and partner. So major new investments are required. And therefore, it's better to buy than to make yourself. That's an economic factor. Suppliers have lower return on investment targets. That's usually the case, that suppliers smaller tier is not subject to, let's say, stock markets, and can be more flexible with investments. Or if we have an insufficient in-house skills capabilities, our people do not know how to do it, or are difficult to acquire. If it's very difficult to have the right people to do that process or product. Yeah, and that's basically it. Okay. So, are we cool? Questions, please. Does it help to have such an overview? So now let's make some numbers. I don't know. You're not giving any feedback, so it's quite difficult for me to assess. Let's make some numbers. as promised, we make a break-even analysis. Analysis. And this is something that very well could be part of the exam, okay? Let's say we have a product in which we have a total cost. I mean, we have some parameters. We have the total cost, or TC. We have the variable cost, or VC. We have some fixed cost, FC. Okay. We know that the total cost is the variable cost plus the fixed cost. And let's say we have a, okay, I just put it here in a graphic. Here is the quantity that we sell, and then on a vertical, and this is a very simple model, okay, just is the euros that we are making. Then let's represent here some of the stuff. We have the fixed cost, let's have them constant. I put it in blue. Okay, this is the curve FC. And we have the variable cost. Let me make it like this. Variable cost. VC. So this means that we have a total cost of this amount. Okay, this is simple as a pimple. So this is the total cost, which is the sum of fixed cost plus okay, so this is our cost curve, and then we have other curve, which is the sales. If we have no products sold, then we don't earn anything, so this is our sales curve. Sales, okay. Where is our break-even point? Somebody tell me. Just intuitively, this point represents the break-even. Okay, and this area here that here is our profit, and this area here is our loss. Okay, So when we start making money, we have our break-even point because we start having a benefit. The point here is the break-even sales. Okay, so the break-even point in this simple linear model, BEP, equals the fixed cost divided by the selling price per unit minus the variable cost per unit. Okay, so you can do the math. This is simple algebra. Is just the point where sales and total cost get together. That's kind of the break-even point. So an example, pretty easy example, but firm buys a product for €500 each in case they make the product, they make it, the fixed cost is €4 million and the variable cost is €300 per unit. The demand is 1,500 units. Should we make or buy? Okay, it's always the same. So we have a selling price of €500 per unit. We have a variable cost of €300 per unit. And we have a fixed cost. So these are the data of €4 million. With all this, we can calculate the break-even point. Break-even point equals €4 million divided by €500 per unit minus €300 per unit equals 20,000 units. Okay. since the demand is only 1500 units, smaller than the break-even point, what should we do? Should we make or buy? Hello? Should we make or buy? Hello? Please answer. Try to answer. Should we make or should we buy? Hello? Please try. Can you hear me? The break-even point is 20,000. Okay, so I'm not going to continue if you don't answer. So please try. The break-even point is 20,000. This means this is our total cost. Because we only have the variable cost. We only have the fixed cost, so this is our fixed cost, 4 million. And we make some money. Because we have some variable cost of 300 euros per unit. So we have here the total cost and here the variable cost. Okay, so this is the variable cost. And this is the total cost. And then we are making some money, a little bit more than we're making some money. This is the sales. We make 500 per product. This is the number of products sold, and our break-even point turns out to be 20,000. But our demand is only 1500. So should we buy or should we make it? Yes. Exactly. So we should buy, because in this case we only have, thank you, Christian. In this case we only have a demand of 1500, so we will be in the loss area. Okay, we will be in the loss area because we only have 1500 units of demand. If we don't have a demand bigger than 20,000, we will not reach the break-even point, and so we lose money, and so we should not buy. Thank you, Christian, very much. I don't know how I can engage you more. I don't know if it's the language that or the English, or you can also answer in German. I don't care, but I need some sort of feedback. Otherwise, it's super difficult. Should buy the product. Otherwise, as Christian said, the product, we lose money because we lose money if we make, because we don't achieve the break-even point. Okay. Well, as I said, please try to participate a little bit more in the lecture. Otherwise, it's quite difficult for me to deliver the results, or to get a feeling of what you understand, what you don't understand. Anyway, I'm done for today. Hope you have a nice rest of the week. Please stay safe and healthy.